Okay, welcome to TheoTrade. My name is Don Kaufman, and in this video we're going to be talking about spread trading options. So if you've had some degree of options experience, you're kind of familiar with what a call is, you're kind of familiar with what a put is, the next step might for you, to consider using spreads. And the type of spreads I'm going to talk about here happen to be none other than vertical spreads. We'll start with vertical spreads. There's vertical spreads, and then there's calendar spreads. And the vertical spread is a very efficient way to kind of just get your feet wet in understanding spread trading. But before I go deeply into why we might do spread trades, you just got to look at risk of a given option. Okay, so I've selected Netflix because Netflix's got a little bit of risk. I mean, this underlying can move up, it can move down. I mean, this thing's been all over the place. You give a day, any given day here, and look at the high on the day happens to be none other than, and this is actually worth highlighting here. 127. The low on the day has been 121. I don't know about you, but that's a pretty big range you got yourself on the day over there. So just consider, something's bouncing around $5, $6, $7 a day. Consider risk management. And that's, to me, what spreads really afford you, right? So when people talk about like spread trading options, they always look at what are the attributes? What are the attributes? The first thing you got to do is what kind of risk do they control? So here we are on Netflix, and we've got an option that's 23 days remaining to expiration. And I really picked that kind of arbitrarily, but this is a 127 call. And the 127 call, it's trading for $5.70. Yeah, the mid price is like $5.60 in that neighborhood, but hey, it's a live market. What are you going to do? Bouncing all over the place. But in this trade, what's your risk? It's roughly $5.60 plus whatever the transaction costs happen to be over there. And everything you're paying for in this particular option is nothing more than time value, because it's the 127 call. Okay? What does the 127 call give the right to do? The right to buy the stock at 127. The stock right now is trading at 126.60. So not gonna be worth very much if this was expiration day, right? Like, who wants the right to buy the stock at 127 when right now you can go out and buy it for 126.56? So the idea of the spread initially is to mitigate some of that outstanding risk. So if you think of a spread this way, you're just going to buy one option. In this case, let's consider buying like a 127 call, okay? And then, for instance, selling a 130 against it. Now, buying a 127 call, it's going to cost you about $5.60. Then you're going to turn around and you're going to sell the 130 call about $4.20. Okay, so why are you selling the 130 call? Well, again, quite eloquently put, because I don't want $5.60 of risk. By selling the 130 call, okay, you're ultimately collecting back $4 and change of that. And the spread is placed, okay, by right-clicking on this is, of course, on Thinkorswim. We're going to right-click. We're going to come up to buy, okay? Then we're going to come all the way up to vertical. So I'm going to actually do that again. So everybody's familiar with it. We right-click on the 127s. Again, that's a right-click on the 127s. We go up to buy, all the way up to vertical. We'll left-click on vertical. And lo and behold, we have a 127, 130 call spread for approximately $1.33 debit. Now, this trade is it's placed as a package. You're not buying one and then selling the other. You're doing it as a package. The buy and sell is all for one net price. It's kind of like if you you go check out at some store, you don't go like, I want to buy the chicken, and then separately I want to buy the eggs, and then separately I want to buy the milk out there. You just basically go chicken, eggs, milk, it's all under one lump sum, and that's kind of what you do with the spread over here. So you're buying one and selling the other. And ultimately, it mitigates a huge amount of your risk. Instead of having that, that big enchilada of like $5 and change out there, okay, now you only have $1.30. What's the downside? He bought the 127 call. The 127 call gives you the right to buy the stock at 127. Then you sold the 130 call. The 130 call Okay, the 130 call gives somebody else the right to take stock from you at 130. Now your thinking is, I don't ever want to even own the stock. I want nothing to do with the stock. That's okay. We have no intention of actually owning the stock. Okay, we're going to go out there, we're going to buy the spread. And if the stock does move up, because this is a bullish spread, okay, a 127 call, what do I do? If I buy a 127 call, I want the stock to go up. Okay, where do I want the stock to go? It can go to the moon. It can go to the moon, but you have the right to buy the stock at 127. Somebody else has the right to take stock from you at 130. The most you can make on this spread is $3, of which you've already paid out a $1.35 debit up front. So you have limited your upside potential to $3, again, of which you've already paid a $1.35 out. So you start to do the math, and when you hit confirm and send, you'll see it on there. Yes, you can only make, what? $1.65. But you can only lose a $1.35. It's risk mitigation at its greatest. And that's one of the things you really want to focus on when doing spread trades. It's about risk mitigation. All the time, people are trying to hit home runs, and they don't think about these simple ideas. Now, one last thing I'm going to leave you with, and, we'll do many, many more videos and classes here at TheoTrade on spreads, because however simple spread sounds, it's all about the criteria you use to build the trade. You pick the wrong spread, you put yourself, again, at kind of extraordinary risk over there. And what we do here at TheoTrade, it's going through not just what a spread is. You can read anywhere what a spread happens to be. What you can't do, though, is get that specific criteria that we provide to be able to build these trades and build them effectively. Now, I'm going to show you kind of what that means. One of the things is, what time frame do you build a trade on? Do you build it 31 days out? Do you build it 23 days out? Like, really, how long, do you build that spread for? Which options do you want to use in that spread? Do I use the 126, 127? Could I use the 126, for instance, 128? Ooh, look at that. $2 wide spread trading for about $1. If I use the 31-day options, these are the 31-day options, but what if I were to use, instead of the 31-day option, I'm going to change the expiration cycle. Let's say I use just the regular December options. So you see, I just switched to the December options. That trade's still for $1. One of the old adages is, people always tell me, like, options cost more if you go further out in time. Guess what? You can be right, you can be wrong, but don't tell me that options are necessarily going to cost more the further you go out in time. Because here's the exact same spread that I pulled up. We're going to go to buy, and we're going to the January 45 days out. We're going to go buy, we're going to go up to vertical. And now we're going to use the 126, 128 spread here. And again, I'm just playing around with different strikes. It too is trading for $1. So I just want you to see that no matter, for the most part, what expiration I've used. I looked at a 45-day expiration. Then I dropped it to the Jan 2s, which is 31-day expiration. It's still trading for $1. Then I'll trade it to the, Dece 2s. The Dece 2s, those only have 3 days left in each one of those spreads. Time did not cost me more. There are ways, if you use the right options in vertical spreads, there are ways to offset decay. More importantly, though, again, selection of the right options is everything. What expiration? Do I go in the money? Do I go out of the money? Do I buy the spread? Because we could consider selling the opposing spread. And that's where some of the complexity kind of comes in here, with really spread trading options. Thanks a lot, everybody, for joining us here at TheoTrade.